topic today is our daily edition of Charting the Markets. My name is Lee Bohl, and I'm a trading services manager with Charles Schwab out here in California. With me today, back from a 2-week hiatus, is my friend and trading colleague on Tuesday, Skylar Marin, who is a CFA, so we need to listen to him. But Skylar, where are you? I know you've been between Phoenix and Texas. Where are you today?
I am currently in Texas at the new corporate headquarters here in Westlake, or what will become the new headquarters, I would say. So very excited to be out here.
All righty. Now we got our location services all done. Let's go on to the disclosures. You can send in your questions in the Q&A functionality underneath the presentation window. Your questions are private and will only be seen by Skylar and myself. We'll keep our eye on them to make it as interactive as possible, but we can't always get to all questions due to the number of people on these sessions. We have our written disclosures we're required to show. Everything Skylar and I talk about should be considered as educational and informational in nature only, not to be construed as a personalized trading recommendation. Any expressions of opinion that either of us make could change at any time based on market conditions. We look at a lot of charts, but we don't recommend the use of technical analysis as your sole means of investment research. We also look at ETFs and ETNs. If you're going to trade those, read a prospectus. We also look at futures contracts. If you trade those, do read the risk disclosure document for futures and options. And with that, I'll put up the heat map to review some of the news here in a second. If I miss anything, Skylar, just let me know.
Will do.
All right, so look at the euro. The euro has been moving up really fast. German Chancellor Angela Merkel is reportedly talking to lawmakers about another 50 to 100 billion euros of stimulus funds for Germany. Also, just to show you how the market is looking at everything half full as opposed to half empty, the French Finance Ministry lowered France's 2020 GDP forecast to 11 for a drop of 11% from a drop of 8%. You would think that would be bad? It increases the hope for more stimulus. So,
we're
Euro
back
stock.
in the bad news is good news mentality. I'll take it. Okay.
That's right. This is we've told you not to fight the Fed and don't fight central banks. So that mantra still is in effect. Now, over in England, Bank of England's monthly data for April showed a massive decline in consumer credit. Obviously, this is closely tied to the fact that the UK consumers weren't able to spend very much in April given the lockdown. But it's still an important point that consumers weren't taking on debt in aggregate to maintain what spending they were doing. And then you look at the US high frequency data, it's the same story. People are not taking on more debt. They're reducing their outstanding credit balances, actually. So what does this mean? It means that the market thinks again, we don't care they're not spending. That means they have plenty of money to spend when they start spending. Buy the market. It's the same thing, right? It's exactly bad news is good news once again.
I would say one other note on that one, Liz Ann kind of referenced it in her article that the consumer went into this recession with better kind of, I'd say, personal balance sheets than traditionally. Like usually they're over leveraged, but since the Great Recession, there's great deleveraging, as it's kind of been termed in that sense. Consumers have tended to be a little bit more cash heavy than traditional. And so it seems that this sort of scare or shock is just kind of reinforcing that theme, I think.
Yeah, so I guess that means either spending is going to remain subdued as people change their habits. The market seems to take the view that it looks like that at some point they're going to open up, right?
Right.
It's, believe what you will. All right, we covered this on Trader Talk, but for those of you who didn't join that, we did a little review of the coronavirus situation. So most of the world's hotspots in Europe are near zero cases and falling. Italy and Germany have recorded low and stable new cases. This is notable because this is not what is going on in the US, unfortunately. We are still seeing some states that are relatively stable, but there are other states where we're still getting rising cases. A lot of those are Mississippi, North Carolina, Alabama, California out here, Utah, Arizona, South Carolina, Kentucky, Arizona, and Texas are still getting higher case counts. So what does this mean? It doesn't mean that we are following, it means that we're not following the same path as countries that really do have it under control. So that is working in the background. And then you add to that the fear right now that all these protests, people were really packed together. And if you look at a lot of the pictures, most of them are wearing masks.
Right.
So that, will that lead to another flash of cases? I don't know. But anyway, so we talked about, let's look at the Euro chart actually. You can see it broke out. Mike Zaremski pointed that out last week, and we've had a really good rally. This is based on the hopes for more stimulus in the Eurozone and path of least resistance. Now, if you had been long, this is a logical place. You can see that previous swing high to take a little profit, but the trend is certainly up. And 10-day moving average now seems to be getting in play because the last good pullback, that's where it held. So maybe keep your eye on that if you're trading the euro. If you don't want to trade the futures, there is an ETF, the FXE. It's not quite the same, but
as I say, that looks quite a bit different as far as technically speaking. But
yeah, but that's your option if you don't want to trade the futures. Now, remember we had said last week, I said to keep an eye on, because of the stimulus and what was going on, to keep an eye on the Euro Stock 50. And this trade has continued to work. We pointed it out in here. Looks like we're going to go and fill this gap. So it looks like the next stop here, at least many technicians would say, would be about 35.30-ish. So this trade has been working. Not that we give recommendations, just observations is what we do. But I'm observing it going up.
Well phrased, I think.
Yeah. Now, the other thing that has been going on is what is going on with some of the metals. Let's put up silver. Okay, we broke out of the flag. We have now pulled back to the 10-day moving average with a bearish engulfing candle. I am thinking that we got up here. I would be taking some profits. At least some traders would be right around here for a couple of reasons. One, you have resistance that we couldn't get through and we turned around right at it. Now, if you're trading the ETF, very similar, right? But let's go back to, look at this move off of the bottom, okay? We went up basically 50% in 50 trading days, okay? The other thing that has happened is the gold-silver ratio has dropped by 24% in 50 trading days. Let me put up that gold. And I'm going to tell you what this means historically. So let's get the gold-silver ratio up here. All right, so it's actually down about 30%. It was 125-ish, it's now at 92. So here's another reason if you are long, and it's still an uptrend, but maybe you just lighten up a little bit. Why? Because if you look historically, when silver has rallied 50% over 50 days, there's been several occurrences of this, about 11 of them. 1 month later, silver was only up 22% of the time. And If you take out the two earliest signals, where you could say things maybe aren't quite the same, but that was 1974 and 1979. If you take those two out, it has never been up a month later, ever. Okay. It was, let's take a look also when the gold silver ratio drops at least 25% over 50 days. A month later, silver was only up 11% of the time. So that suggests that you might want to take a little bit of profit there.
Lee, does when the silver ratio decreases by that amount, does it say anything about the trend for the ratio? Does that continue to change, or do you have any data on that one?
The ratio continues to go down a bit. Yeah.
Okay.
Yeah. So that is kind of interesting. So let's take a look at the gold and silver miners to see if they're at a place where you might take profits or not. Let's put up the silver miners first. A little bit of a short-term double top. I mean, the miners are, I mean, the price of silver is, it's higher than it was. So maybe the miners might hold up a little bit better than the metal, but perhaps, you would lighten up a little bit in two places. If it closes below the 10-day moving average, that might be a place to lighten up a little bit if it happened. And the second place to maybe cut your position way back would be if the silver miners broke that 33.80. All right, let us take a look at the gold miners. That is a nastier looking chart than the silver miners. We've taken out the 10-day. This is why I'm afraid it might happen to the silver miners, but only until it happens. Those who look for patterns could say this is kind of a head and shoulders too, very short term. Let's just draw that in there. Okay, so key, if you're in this for the longer term, I would think this low right here at about 32.70 is something you might want to keep your eye on. You're probably okay if it can stay above that, but if it broke, it would have broke the neckline and your downside target based on the measured move. Remember, they're just approximations. It'd be 37 down to basically 33-ish. So figure 4 points. 33 would take you down to about 29, which is right in here somewhere. So a little higher than there. But anyway, so just watch, if you're in those, just watch them because you could have a pullback coming maybe. You got any other thoughts on the metals?
I was kind of curious, or just thinking about the kind of the rotation, because I know gold had gotten so far ahead of silver for the last few months, but there's also been kind of a disconnect between a few different things as far as I know Kleintop likes to draw the jaws before they revert. But so that's why I was kind of curious if together they continue to move, if they both went down at the same time, but if silver outperformed relative to gold, or if it would be something that you'd expect they just both, if that reverts back. That's why I was kind of curious about that data. But
yeah, well, actually, when the gold silver ratio dropped as much as it did, I mean, it wasn't. It is uniformly bearish based on all those data points. It's definitely bearish for silver. It's not uniformly bearish for gold though.
Okay.
Which would steady that ratio a little bit, right? If silver was weaker and gold didn't always go down. So yeah. All right, let us got a request for emerging markets. Let's see. So they should be doing better because the dollar has broken 98, and you can see it's down further today. We can't get the DX here on real time, but I can show you where it closed last night. So it broke that key 98 level a couple days ago, continuing to go down, and down more today. So that would help the metals a little bit, but I think you've already had pretty good run up in them.
Yeah.
So we wanted to look at GLD itself.
Yeah, as I said, there's a couple requests for that. So
we've been kind of the view here that we've gone from a bullish chart to a neutral chart, and I think it's in a trading range right now. Now, I would say it's still something longer term, which could be okay. Because if the dollar keeps dropping, that'll add some support. Interest rates are low, so those two things are generally positive for gold. But you see, we have the momentum has waned, and now we're more in a trading range. So watch it if it gets down to the bottom of the range. That might be a place if you wanted to add exposure, you might want to do it. Or on the other hand, of course, the way you trade a range, if it breaks out, go with the breakout. But we hit that awfully recently 3 times in a row. We weren't able to break through 164-ish. So that's what I would say is going on here. Trading range on that. All right. Now let's look at emerging markets.
It's a less convincing head and shoulders. I mean, you got a couple of the little peaks, but not enough to, I don't think, shape it in the same way that GDX did. But yeah.
Right. Yeah, as you might suspect, emerging markets are getting a bit of a bid with the dollar decreasing. Remember, generally emerging markets trade inverse to the dollar because they have so much dollar-denominated debt. When the dollar weakens, it's easier for them to pay back both their companies and their governments. So looks like this is an improving chart for sure. Next target may be the upper resistance line around 42.10, perhaps. Now we traded back and forth through the 10-day moving average. If you're trying to manage your risk, it looks like I would be more inclined to follow the 20-day moving average. As you can see, it's been much better. So obviously, the first place you would lighten up your position is if we crack 37.80. But if you wanted to give a little bit more room, you could use the 20-day moving average. Again, looks like the upside target for many traders would be 42.10. All right. We could look at oil. Chugging along to 36-ish.
Yeah, look at that.
And we might break out again. Depends on how you draw this, too. You could have already, I mean, this is kind of however you want to draw it. You could say it did break out, or if you wanted to use the gap in here as the top, then it's still just now breaking or almost breaking out, or maybe it is. Maybe this, though, because this is an inverse head and shoulders, a pretty good one. So what would the measured move be here? Well, I don't think it would do it, but I mean,
say that'd be
a big move. It'd be 15 to, it'd be $20. It'd be put you back into 55-ish in here.
I mean, that'd be great for the exploration production companies, that's for sure.
Well, it would. And we'll take a look at those. They've been doing okay, and the XLE is threatening to fill a couple gaps too. We'll take a look at that when we look at the sectors.
I would say fundamentally, I mean, oil's getting a little bit of a bid because, I mean, you keep getting production cuts reduce, and at the same time, demand's hopefully starting to increase a little bit to offset. But there's still a lot of supply to burn through. So I'm kind of, I guess I have trouble being as bullish on it. But at the same time, I mean, technically, it looks, from a technical perspective, I think it very much does. I mean, pretend going up, right?
Yeah, for sure. All right. All right, well, here is the market. Now, before I got a lot of requests to repeat what I did yesterday about civil unrest. The basic conclusion is that usually the markets shake it off, but Had many requests to see those charts again. So let's do that. All right. This was the summer of 1967, called the Long Hot Summer. They're from June 26th until August. There was 12 or 13 civil unrest riots across the country, all over the place. Newark, Detroit, all over. You can see that initially, this was the first one. A little bit of a drop, but then we shook it off. Okay. The next one was Kent State. This was May 2nd, or was it May 4th? And I think it was May 2nd was the where the 13 people got shot. The market did drop 3% that day. This was a little bit different in that it kept going down. But remember, we had this was part of the bull market pullback from the 1968 highs. But again, you can see that it didn't have any lasting long-term effect. And the other one was the Rodney King. I lived in LA then. I know all about that one. Here is the chart for Rodney King and the LA riots. First day was April 29th. So you can see, except for 1970, the markets have shook off this. Now that said, if you get many more deaths, especially at the hand of the authorities, then maybe you revert to the 1970 model. I don't know. But right now, the market is shaking it off like it did in 1967 and 1992.
I would almost say that given the environment, it's kind of an interesting thing that with kind of the phased openings, it would have a more muted impact. The protests and riots would have a muted impact on economic activity because there's not as much yet happening. And so as far as it translating to significant impacts in the stock market, I'd expect it to be determined by, what the aggregate impact is on, I'd say, commerce, right? And but because there's not a lot of that currently and it's phased reopenings, I'd expect that to be muted overall, right? So I can see why we can rationally say that it shouldn't be doing or affecting the markets as much, or how we can rationalize that away, short of some escalating impact, I think.
Yeah, that's a good observation. All right. So what do you think of the market? It continues to grind higher. I think what's going on here is you have your classic pain trade. People just don't believe it with what's going on. The trend is your friend until it bends. The trend is up. It's the Fed put. It's at some point, yeah, it's going to stop. But
and I think the difficult thing, right, is it's the market's climb on the wall of worry, right? And it's as the market keeps climbing higher, all the people who have been sitting in cash not believing it still, or at some point, get persuaded to buy in, right? Maybe that's during another pullback and they feel like, okay, now I have to jump in. But
the
just
market's not giving them a chance.
Yeah, hasn't yet. But I mean, you can see that if it keeps moving higher and people like more and more, I'd say researchers or analysts are starting to kind of buy into it, then suddenly you start seeing enough people that have to just kind of chase the rally, which again, that's probably when you might get an opportunity to actually get it as the market kind of reverts a little bit. But I mean, yeah, Randy Frederick was talking about this one pretty specifically. We're officially in a new, bull market. So short of thinking a 5 to 10% correction could happen, but not expecting to see the lows again. So that's where you can start to see people say throwing in the towel and just buying in, right?
Yeah, that's right. Now let's talk about valuation a little bit too. Believe it or not, I hear scuttlebutt, and I couldn't believe this. This was in the last couple of days, talking to some, trading desks. they are not even basing decisions, a lot of institutions, on 2021 earnings. They are basing decisions on 2022 earnings. I my jaw dropped when I heard that. But that's what I've heard. Let's talk about valuations a little bit. So just a few things. What is the estimates for the rest of 2020 and 2021? Okay, and what are the PE ratios? Well, right now, the best estimates for the S&P earnings for 2020 is 128 a share. I think Liz Ann might have said 125. But that's in that range. That puts the PE around 23 and a half, the current PE, or the trailing, the current PE, which obviously is higher than average. Now, 2021 earnings, okay, which at S&P of 3,000 gives you a PE of 1829. 5-year average is 16.8, and the 10-year average is 15.1. So, and then you take a look. Number one, those earnings estimates, I don't think are companies issue. Yeah, I saw this, right? At this time of the quarter, companies issuing guidance for Q2 is only at 46, where the 5-year average you'd have 107. So it just shows you how much are withdrawn guidance. Okay. As a matter of fact, through May 28th, 178 of the S&P 500 companies had withdrawn or confirmed their previous withdrawal of annual guidance for fiscal year 2020. So I think, these earnings, we get these estimates usually from FactSet, and they're doing the best they can, but with all that, what do you know? I don't know. So the forward PE for the next 12 months, okay, so the last 2 quarters this year and 2 quarters next year, based on the best estimates, is 21 and a half, which is also pretty high. The last time the forward PE ratio was at 21 or higher was January 2002. So anyway, there is that. But I say people are almost saying, like, we don't care what happens in 2021, 2000 and 2022.
That I mean, you clearly have difficulty with that as well, but it's
just.
And it's, I'd say the other thing, and there's some comments on this one as far as what the kind of underlying destruction that's happening to to companies' balance sheets, right? Even if you start discounting out to 2022, which is getting ridiculously unreliable, you have to factor in, everything else that's happened to the companies in between now and then, with a slower growth environment, with the changing employment environment, the changing, there's just so much else that's changing there, to try and again price in perfection that far out. That's a difficult thing to really get excited about as far as buying into. But
yeah, I think you just got to watch what the market is doing, because with so much guidance off the table, I think you just got to go with price action. Really, right now the price action is good.
Yeah,
I say. So yeah, let's put up the other thing people are watching. We're above the 200-day for a week now. That's certainly a place, if the market did pull back, it would stop. We got a question: is there any talk of a Democratic sweep for the fall elections? No, but if you look at the VIX curve, they are suggesting there's going to be a lot of volatility in November. One way
That
or the
sounds
other.
right.
Yeah. Um, yeah. All right. Now the Nasdaq is lagging a little bit today. I think this is due to the tech sector being not as robust as it could, at least some of them, because people are trying to figure out what the tensions between U.S. and China are. Now, there's also been conflicting reports about that. They said that some of the big state-owned, we talked about this yesterday, some of the big state-owned companies in China, like Sino-Grain, were told not to buy or pause their purchases of U.S. stuff. But then there was news today that they just bought 2 cargo ships worth of soybeans. So, I mean, you can see that soybeans shot up on that news. So I think there's so many conflicting things. I think this is when just following price action is something to watch very carefully, because it's kind of hard to do fundamental analysis, right, with all these things going on.
It really is.
You can try, but watch the 20-day moving average for any pullbacks on the Nasdaq. We are coming to a very minor resistance level here, but right now we're just a shade above it. Let's take a look at the Qs themselves. The Nasdaq 100. It's going to test the all-time high, most likely.
Just right there. I mean, I can kind of buy into some of that a little bit more, as far as, rotation, or not even rotation, but kind of the changing to work from home, more of a focus on technology companies. Like, I can kind of understand that. Well, maybe not all-time highs, but I can understand the interest in just a select few companies. But it's, all-time highs. It speaks to something.
It does.
Yeah.
We'll take a look at the Russell. Once again, it's been outperforming the last few days. It looks like it key level here, it broke through, and like a good trending index, held the breakout level on the pullback. So looks like next stop for many traders would be the 200-day moving average on the Russell. Let's just take a look at market breadth real quick. Let's see if we get any indications there. I haven't seen anything disastrous one way or the other, but let's take a look at the S&P advanced to decline line. It's going in the right direction. It is higher than the last time we were up here, but not by much, but you can't say there's a divergence on that one.
Right.
Let's take a look at the NASDAQ advanced decline line, and then we'll take a look at the Q's advanced decline line. So let's take a look at the okay, it's a little bit less than it was at the previous high, and we're higher, but that's not glaringly bad.
Yeah.
And then let's look at the NASDAQ 100 advanced decline line. That's giving you confirmation, at least on those.
Yeah.
So you can't say the market breadth is something that's a real worry right now. All right.
I would
go ahead.
Just wanted to make one call out to something here. When you're referencing how difficult it is to use like fundamental data in kind of telegraphing direction of the market right now, there's a couple things on that are very accurate. I mean, if you're following like economic forecasting, models are wildly unreliable in predicting recessions. but a lot of that data is always lagging behind when coming out of it, because it's, even if you're using like coincidental data, it's still always backwards looking. And so the models that people use to kind of predict that, it's difficult because, we want to see some sort of substantive, like, or constructive action in the data to justify the moves we have. But historically, you just don't get that until much, much later. And so it's, when we're looking at these things, it's like, yeah, it'd be nice to have something to confirm this, but it's that'll come kind of far enough down the line that it'll be, you've missed the move historically, at least, right?
Right. Yep. All right, let's take a look at the sector action today.
You've got some different ones here.
Yeah, well, yeah, I changed this a little bit just because people keep asking about ETFs. So oil services. So let's take a look at the energy group. We mentioned it earlier with oil north of. Yeah, see, I told you we're breaking out and filling a gap, and that's what's happening.
Yeah.
20-day looks very predictive on this. Now, granted, that gap is pretty close, but maybe we'll get back to the 200-day moving average.
Yeah.
And you had mentioned the exploration stocks, so take a look at them. Holding the 20-day, they've already filled their gap.
Yeah.
Right? So look at how it held the 20 and this little pullback it had. I mean, the bear would say, well, we didn't make a new high and we're in a trading range, but it's not a negative chart.
Yeah.
Say that.
As long as it's holding the 20, it's still fairly constructive, right?
Yeah, let's look at the refiners. Nice.
That looks good.
Yeah, that so far that's one of the better looking charts. Let's look at oil services. Yeah.
Yeah. Mm-hmm.
This one's got a little ways to go too, because it's got a much bigger gap that it could fill. So you'd have to say the energy complex is, which has been lagging for so long, maybe a place to take a look.
Yeah.
All right, let's see what else is moving here today. We already looked at the gold and silver miners. We were following home builders.
Say it's copper constructive. We'll see too, but
yeah, we'll take a look at copper. Yeah, Kevin and I were talking about this earlier on Trader Talk. It looked like maybe the run might have been over because you had this pop out of the channel and then you had what's called a bearish engulfing candlestick,
right,
which can be a short-term pullback sign, and it didn't happen. We just went down to the 200 and held it. So I think the path of least resistance is still higher on these. I mean, we mentioned this a long time ago, these guys.
Is this more of a play on recovery of activity or interest rates, do you think?
I think more interest rates, because I mean, this is going up and not strong. These are the mortgage REITs. But rates are relatively low. The problem seems to be that prices aren't coming down because the inventory for sale is apparently pretty low.
Right.
So since the inventory is low, that would seem that the builders would want to take advantage and build more stuff. So maybe that's why the home builders are doing so well.
That makes sense.
Yeah. See what else is moving.
I'll take the low inventory as I sell a house,
Yeah. You wanted to look at copper and the copper miner, so we can do that. Let's take a look, see if the doctor is confirming the rally here. Have to say so.
Oh, well, yeah, nothing wrong there.
No, it looks like test of the 200-day moving average is in the cards. Take a look at the copper miners. Yeah. Not a huge, I mean, it's not the fastest moving thing, but it's grinding higher. So it's kind of supportive of the rally.
Yeah. Seems like most things are supportive at this point.
I know it's like you fight against the trend at your own risk. At some point, you're going to be right, but
yeah,
in the meantime,
there's a whole lot of upside that's been happening. Yeah.
Let's take a look at this one. These are the Chinese internet stocks. They're really going to move. Yeah, they're breaking out. So if you like breakouts, here you go.
Yeah. I was curious how the interplay with Hong Kong is going to play into like the emerging market stocks. It's kind of surprising that given the news around that one, we're still getting as much constructive action as we are.
Yeah. But, so anyway, you want a breakout play? There you go. Let's just go to the weekly. It's the yeah. See if they break out, you got quite a ways they could run.
Yeah.
All right. We had a question. Do you have any clues for how to anticipate how the market might close on a day like today? They've been, I would say it was, nobody knows for sure, but certainly it feels like a trend day, which means they buy any little pullback.
Mm-hmm.
I wouldn't be looking for a huge weak reversal, barring any news headline. You could always have that, of course, right?
Yeah.
We're going out of the phase one deal with China.
That would do it.
That would do it,
I was reading as far as like relative performance, some of the trading strategies, like as far as buying into the close or selling into the close. But one of the ones that has had like the most success in the last couple months is buying at the open and then just selling at the close, because intraday, so many of them have just been strong rallies during the day, but opening basically flat. So from the previous day. So it's kind of interesting.
Yeah. So I don't know. I'd say it's a little bit higher chance that we're not going to pull back for the rest of the day.
Yeah.
All right. Let's see what else is moving.
I like this list. You got some odd ones.
Yeah. like lithium. For the daily. Well, set your risk on this one.
There's a question about support on KWEB where we just were.
I would put a stop just a little under these three highs here at about 53. You can get hurt too bad, but you got quite a bit upside if it goes.
Yeah.
All right. Let's see. We saw coal on the list.
Kind of an odd one. Yeah.
Yeah. Well,
what's not to like with any of these charts? I mean, this one's not as good, but
yeah, I mean, but again, you can set your risk on these really well if you want to. Yeah. All right, what else? Let's take a look at the biotechs and healthcare. We haven't done that in a while.
Yeah.
Healthcare is range bound. We've been saying that. Just at the top of the range in here, but watch for a breakout.
Still holding the 20 as well on that one.
Yeah. So there's your range. And then let's see how the biotechs have done. Look at all those tails on the 20. So this basically looks to me like an ascending triangle. draw that in here. Here.
Hmm.
Then you got the 20 right there. So I think the trade at this stage is break one way or the other. But it is very interesting to me that it got down to the 20 and they just bought the heck out of it. Look
Yep.
at that tail on there. Well, let's take a look at the XBI.
Let's say ascending triangles tend to be continuation positives, right?
Right.
Yeah.
Not quite, but they held the 22.
Yeah.
So they're looking okay. And with that, Skylar, unfortunately, our time is up. Thanks
Indeed.
for coming back in to Charting the Markets. Coming up next, 8 steps to keep your trading on track with my buddy out in the Big Apple, fellow CMT Mike Bruskoff. So stay tuned.